What if the market crash is already underway and you just don't see it yet? The big ones, the crashes that redefine economies and wreck personal fortunes, they never feel obvious at first. By the time everyone's talking about it, it's already too late. But history, it leaves a pattern. And when you know what to look for, you can see it coming. Not always the exact day or even the hour, but the warning signs, those always come first. Now today, we're going to walk through the 4 signs that show up again and again before every major market crash. And we're not just going to talk theory, we're going to look at actual historical crashes, starting with the first one ever recorded. And we're going to trace these same patterns throughout the centuries. Because no matter how much technology or regulation changes, human psychology doesn't change at all. The greed, the optimism, the belief that this time is different, that part never changes. Now let's go all the way back to the 1600s. The Netherlands was booming. They had just launched the East India Trading Company, created the first modern stock exchange, and they were rapidly becoming the global center of trade. Wealth was flowing in, and people wanted to show it off. And that's where the tulips came in. Yes, the tulips. They were rare, beautiful, and for a short while, they were incredibly expensive. Owning a rare tulip bulb became a status symbol, something to flex in paintings and parties. A single bulb could sell for the equivalent of thousands of dollars. But then something new entered the scene: futures contracts. People started buying the right to purchase tulips at a future date. When prices kept rising, those contracts became more valuable than the tulips themselves. So people started trading contracts, paper promises, with no intention of ever planting a flower. It became a game of flipping paper. The underlying asset, the actual tulip, it was just an excuse. This was the first pattern: rampant speculation fueled by investor overconfidence. It always starts with the belief that something is so valuable, it's just never going to go down. It's never going to crash. It's going to go up forever. And once people start thinking that way, they take on more risk and they assume someone else will always pay more. We saw the same thing with Beanie Babies in the 90s, with cryptos in like 2021, and with meme stocks that had no earnings but a cult following online. The asset doesn't need to be valuable. It just needs hype. At its peak, some tulips were worth more than a canal house in Amsterdam. But once confidence cracked, the entire market collapsed. Now let's move forward a few hundred years to 1929, the Roaring Twenties. They were in full swing. Industrial production was soaring, automobiles, electricity, consumer goods, they were transforming the world. The stock market was printing millionaires. There was a sense that we had entered a new era, an era where downturns were a thing of the past. People borrowed money to buy stocks. Entire investment trusts formed just to layer on debt. Some funds were worth double what their underlying assets were. It became a game of attracting new investors to inflate the price. The government, meanwhile, it just stood by. Few regulations existed. Financial institutions could essentially make up products with no oversight. It was a free-for-all, and it worked. Until it didn't. And this brings us to pattern number 2, regulatory blind spots. Either the regulators are too slow to catch up with new financial products, or they step in way too late and make things worse. In this case, the crash came fast and hard. Markets fell by nearly 90%. The Great Depression began, and millions of lives were shattered. Families lost everything. Banks failed by the thousands. Unemployment reached 25%. The trauma shaped financial behavior of an entire generation. Now, fast forward to 1987, computers were just starting to dominate Wall Street. And one of the new ideas that was starting to gain traction was called portfolio insurance. The idea was simple in theory. If stocks fell, computers would start selling small amounts to limit the losses, like a seatbelt for your investment. But what no one considered is what would happen if all the computers sold at the exact same time. When markets began slipping that October, the computers triggered sell after sell after sell. The market collapsed on a single day, losing 22% in hours. And this is pattern number 3, a new financial innovation that seems brilliant but isn't fully understood. Whether it's the future contracts of the 1600s, leveraged trusts of the 1920s, or algorithmic trading in the 1980s, new tools, they always promise protection or profit until they become the trigger for a crash. And what made this even worse was that everyone trusted the math. People believed the models were smarter than human emotion. But when emotion hit, the models only amplified the panic. The belief in safety created more risk. Now we reach 2008. After the dot-com crash, investors wanted safety. Real estate felt safe. Banks were happy to lend and even happier to package those mortgages into securities. The more loans they made, the more they could sell. It didn't matter if the loans were risky. Banks just bundled them up and sliced them into tranches and sold them off. Investors assumed it was because everything was rated AAA, it would be fine, but those ratings were garbage. They were rubber stamped by the agencies who were paid by the very firms that they were rating. Debt piled up at every level: homeowners, bankers, investors. And when housing prices finally dipped, the entire structure imploded. And this is pattern number 4, excess debt. Whether it's personal, institution, systemic debt, it magnifies risk. It makes small losses catastrophic, and it almost always presents in the lead up to a crash. So let us recap. The first 4 patterns that always show up before a crash are: 1, speculation and investor overconfidence; 2, weak or delayed regulation; 3, new financial innovations that no one really understands; and 4, massive level of debts. Now, if this has been helpful so far, please hit the like button so more people can see my video. And let me know down in the comments below which pattern you think is showing up the most clearly today. Now, you're probably wondering, do any of these apply to today, to right now? Let's take a look. Speculation, meme stocks, crypto, NFTs, AI startups with no revenue and billion-dollar valuations, even used cars and collectibles. They exploded in price during the pandemic. People were flipping Pokemon cards and sneaker drops like they were hedge fund assets. Regulatory failures? Look at crypto. For years it operated as a financial Wild West. Even now, regulators can't agree if crypto is a security or a commodity or something else entirely. Or take buy now, pay later apps. These are essentially personal loans with no credit checks, offered by tech companies with no banking license. Innovation? Tokenized real estate, decentralized finance, AI-powered robo-advisors. Everyone's pitching the next big thing. And most investors, they're pouring in without understanding the risks. The assumption is that the new thing must be smarter and more efficient, so it has to be safer. It's just obvious. And this is the same thing that led back to Black Monday. Debt? Corporate debt's at record highs. Credit card delinquencies are rising. Subprime auto loans, they're starting to come back. Student loans out of control. Governments around the world are spending more and more and more than ever, with rising interest rates making that debt even harder to service. Even average households, they're struggling with car loans, mortgages, mortgage reset, student debt restarting after years on pause. These ingredients are here. Now, does this mean that a crash is coming tomorrow? No. But history says that you should never ignore the warning signs. The same playbook, it shows up every single time. Only the names and the technology changes. So, what can you do? First, don't panic and sell everything. Crashes hurt, but crashing out at the bottom hurts even more. If you miss just the 5 best days of a recovery, your long-term returns take a major hit. Staying invested is usually the better bet. Second, don't try to get rich on timing. Most people who try to time the market miss the bottom and they never get back in. The best investors are not the ones who guess the top. They're the ones who have a plan and stick through the cycles. Dollar cost average. Third, clean up your own debt. You don't want to owe a bunch of money in a downturn. That goes for high interest credit loans, credit cards, adjustable rate mortgages, even margin debt if you're investing on borrowed money. The less debt you carry, the more flexibility you have. Now, fourth, keep cash on hand for opportunities. When stocks fall, assets go on sale. Some of the best investments are made during crashes, not during booms. You can't buy cheap assets if you have no dry powder. Fifth, diversify. Don't bet everything on one stock or one sector or one trend. The people who got wiped out in 2008 were the ones who had everything tied into housing. The people who got wiped out in 2022 were the ones that had everything in speculative tech. Spread your risk. And sixth, understand the game that you're playing. If you're investing for retirement in 20 or 30 years from now, then a crash, it's just a discount. It's a great opportunity to buy, but if you need the money soon, if you're trying to flip a property or retire next year, you need to be much more cautious. Now, if you've made it this far and want more videos like this, hit that subscribe button so you don't miss the next one. And if you've seen the warning signs yourself, share them in the comments below. I would absolutely love to hear your take. Market crashes, they feel scary. And yes, we'll see another one at some point. It's not a matter of if, only when. But having a plan and understanding the pattern means the next one, it doesn't have to bring you down with it. So, thank you so much for watching, and I'll see you next time.